In this video, I want to share with you the asset classes I am most interested in. From there, I want to show you how I take my risk score based on my economic indicator analysis and make my asset allocation decisions. My name is Jared Ayers. If you're new to this channel, I am a CFA charter holder. I've been investing successfully for many years, almost 20 years now, and I've created this channel to share with you the ideas and somewhat unusual strategies I use to invest my own money. So before we jump into the actual asset classes themselves, I want to just recap on the use of the high-level economic indicator analysis. So the main reasons I do that analysis up front before I make any kind of asset allocation decisions or even think about asset classes is really threefold. Number one, it helps me see through the noise and the headlines as to what is actually going on in the economy. Number two, it's based on real data, not my own emotions. After all, I am a human being and I am susceptible to the same things that every other human being is. And when you get nervous or you get scared, sometimes you do things that maybe you otherwise shouldn't. And number three, really, it just gives me an idea of what I should be doing. So once I turn that economic analysis into my risk score, I can then take that and apply it to my actual investment decision. To recap the risk score, it is effectively a weighting of a group of economic indicators that I believe tell the truest story of what's actually going on in the economy. A high score is good, a low score is bad. And really what that risk score does is it allows me to understand, because it's based on real data, what's actually going on in the economy. However, it's also meant to be forward-looking. So it may actually be telling me something that goes against the noise and the current headlines. And so I do have to have a bit of a contrarian hat on in order to sort of believe what the data is telling me. The fact effectively that it could be telling me about something that is about to happen that may be going against what the current headlines and the noise is actually saying. So before we get into the asset classes that I am most interested in, I wanted to share with you an example of a group of asset classes that is basically looked at or thought about by one of the biggest robo-advisors out there, Wealthfront. Now it could be Wealthfront, it could be a different robo-advisor, Wealthsimple if you're in Canada, it could be any kind of financial advisor giving these. I mean, I just want to show you an example of a mix of asset classes that are commonly presented to basically investors that want to put their money and have it managed by somebody else. So this is a picture of a group of assets. You can see at the very top there US stocks, then foreign stocks, emerging markets, dividend stocks. So the first four basically are equities, natural resources. In this case, natural resources means energy, so oil and gas, the actual commodities. Real estate, another asset class, US government bonds, TIPS, municipal bonds, US corporate bonds, and emerging market bonds. Those are all, to me, bonds, but that's how they sort of break it down in terms of different types of bonds. And then risk parity, which looks like a Wealthfront specific asset class that mimics something that was created by Bridgewater Partners, which is Ray Dalio's firm. It's kind of vague on exactly what that is, so I can't really determine what that means. However, this gives you also a little bit of a matrix in terms of the correlations of these different assets to one another. So you can see that, you know, the relationship, for instance, between the equities and the bonds is fairly opposing. So when one goes down, the other one sometimes goes in the opposite direction. So it means up or vice versa. And then, you know, you can see for yourself basically whether it's on this site or a host of any others, the different correlations and asset classes that are used in sort of portfolio selection strategies by advisors and money managers. So just want to give you an idea of what it looks like out there, and then I want to share with you what asset classes I'm most interested in. So just to be clear, I have absolutely no problem with Wealthfront, Wealthsimple, robo-advisors, traditional money managers, any kind of fund. I think they all have their respective place and share of the investment management market. I absolutely do not believe that everybody or even most people should manage their own money. All I'm doing really here is sharing my own views, and they are exactly that, my own views. I don't expect anybody to adopt them. Just want to make that very, very clear up front. So for me, in terms of the asset classes I'm most interested in, as you can tell in that spread of investments, to me, there's only probably maybe 3 or 4 asset classes. For me, the number one really is equities, so stocks, and that doesn't really break down into a region or a market cap or anything like that. For me, equities are equities. If I look at the S&P 500, the NASDAQ, the Russell 2000, the FTSE 100, the Nikkei, any global market index. Even if I was looking at emerging market ETFs, which probably do behave significantly different than the sort of large cap companies in North America or Europe or Asia. But what I find is when the overall market takes a dive, generally speaking, equities go down. It's hard in this world today where everything is so intertwined not to have a sort of domino effect across the globe just about when the overarching economy goes down. So for me, equities is an asset class on its own. I also find I'm not really somebody who's a billionaire or has any kind of sizable amount of money to invest. So for me, I'm not having to buy the market anyway. I'm going to be very selective in the assets I'm choosing. So the asset class in general for me, equities is number one. Bonds is its own asset class to me as well. I mean, certainly there are different types of bonds, different durations, different risk tolerance or risk tolerances, and risk ratings on those assets. And depending on what the markets are doing, which way interest rates are trending, what the spread is between risky and non-risky assets, all these factors may determine which types of bonds I want to own. But again, to me, bonds behave a certain way, and obviously often or should provide a yield. So for me, that's an asset class on its own as well. Cash, which some people may argue is not an asset class, is an asset class to me. There is something called deflation, and when that occurs, although it's very, very rare, certainly in my lifetime, but when it does occur, cash kind of is king. Cash also obviously allows you to take advantage of opportunities when they arise. So to me, that's that always is a part of my overall portfolio. Gold is another one I look to in terms of an asset class. Now, I'll be very clear, and I know there's going to be people that absolutely disagree with what I'm saying, but I don't see gold as a long-term investment. I see it as an asset class in my portfolio to provide a hedge. And that's a long-term view or a long-standing view I've had, that gold remains a commodity, precious metal that people flee to when times of crisis arise. So that is, and it doesn't ever really make up a large portion of my overall portfolio, but does come in and out of it periodically depending on what I believe the economic landscape looks like. And the fifth asset class that I also use is, I guess it could be lumped in as sort of, commodities, but it's more than commodities and really revolves around a specific strategy, specifically managed futures. Now that is a trading strategy that is very different and, traditionally has a very, very low correlation to both equity and bond markets. So I look to that asset class as well to potentially hedge the rest of my portfolio and possibly provide a bit of return when things get a little bit dicey, or when I believe, potentially that's a good spot to be in. So I'll share more about, exactly how I look at each of those asset classes as we move forward here. But basically, that's kind of, how I see things. And there are other asset classes that I do believe have their own place in the alternatives category. But things like real estate, things like private equity, if you're not buying those privately, in other words, if you're buying publicly listed real estate, if you're buying publicly listed private equity, then to me that's all part of equities. So if you're accredited investor and you can go ahead and invest in private equity, or you're just somebody who owns investment properties for yourself, those are how I would see playing those alternative asset classes is directly in the private markets. I think there is, in the private markets is really where you have the potential to actually see a very different and potentially better return than, say, the public markets might provide. So I think your equity strategy may look at real estate, may look at private equity, but I think you have to think about those assets as they're publicly traded, just like any business that you're evaluating. Privately though, there are potential advantages you may be able to take advantage of. So that's really how I look at asset classes. Those are kind of the 5 that I really focus on. So again, equities, bonds, gold, cash, and managed futures. Everything else to me, there's obviously lots of different types within those buckets, but to me, those are kind of the five areas that I look at for my own portfolio. So in terms of how I use the risk score to decide how I allocate my assets to my various asset classes, effectively the risk score is a range. The absolute best possible score is 10, the absolute worst possible score is 0. So that's pretty basic, and I basically, in order to come up with what fills in that range, I start with the absolute most aggressive compared to the absolute most conservative, and then just fill in the blanks from there on a pretty steady basis. So, moving out of the most aggressive towards the most conservative, and the score basically tells me where my allocation should be based on what that score is saying. Now, from a practical standpoint, am I going to actually move into whatever that score is telling me I should move into immediately? No, absolutely not. It gives me a guide though, which I can use to move towards. So, I have to look at my position sizes, I have to look at my transaction costs, I have to look at, what's up, what's down. Most of my accounts are tax sheltered and therefore don't have tax consequences, but certainly if you have cash accounts that do have tax exposure, tax loss harvesting to offset any gains is probably not a bad idea. Of course, your accountant would be able to help you with that. But for me, I'm looking at, if I'm moving away from, let's say, if I'm moving out of equities, or if the indicator score is telling me I should move away from equities, then I may look at which positions are up, say double what a full position might be, and start taking profits from those. If I have excess cash balances and it's saying, well, we should be moving into bonds, well, maybe that's a good way to do that. Just put a little bit more cash into the bond area just to sort of rebalance that portfolio in line with whatever the score is telling me it should be. So really, it's a guide. It's a and usually these things don't fall immediately. The indicators will start to tell a story, and that trend will continue, and I'll follow it over a month or two, or maybe a quarter, and as that trend continues, I'm just watching and waiting and taking advantage of things as they come. So that's really, what I'm actually doing with that score. It's not sort of hit the sell button as soon as the score says something. It's not quite that aggressive. It is, but it does give me my own independent view of what's going on, and therefore what I should be doing, which is really critical, I find, in this world where everything is coming at you in terms of information and media and all forms of advice. So I just have to know myself what I should be doing for me, and then I don't have to really worry about all that noise and all that fun stuff that's going on around me. So just to recap, really, I'm very simple. I don't have billions of dollars to invest, so I like to keep my investment strategy simple. So really 5 asset classes that I'm most curious about: equities, bonds, cash, gold, managed futures. With my economic indicator analysis and corresponding risk score, I all of a sudden have a framework and a guide as to where I should be allocating those assets, or which asset classes I should be allocating to, and effectively I can confidently and completely ignore the noise around me and make my own sound decisions based on my own analysis, at least from an overarching asset class allocation position. So that's basically what I wanted to share with you in this video. If you do like it, please hit the like button. Subscribe if you're new to this channel and you want to learn more, or at least hear my own opinions about what I do. And if you want to leave any comments, questions, feel free as well. And hopefully we'll see you in the next video.